Max Layton, Global Head of Commodity Research at Citi. Max, in some ways, I think it is surprising to see copper rally when you look at the backdrop. China is certainly not firing on all cylinders. We're questioning about the end demand for things like electric vehicles. And here we have copper kind of surging.
Yeah, in some ways it is. But at the same time, I think investors have essentially decided that they have to have the trade on, right? It was a fantastic medium-term story. It has been for the last couple of years. And the thing holding it back, the thing holding investors back from positioning for copper's, what I see is super exciting, actually. I think it's a second secular bull market that we've seen in copper this century, and it's just starting now. Investors, they've been holding off, as I mentioned, basically because of the weak cyclical outlook, particularly for the developed markets. And as you mentioned, China on the property side, lots of concerns there. They just can't afford to hold off anymore. The interest rate cutting cycle, is within sight. There's some reflationary kind of flavor to the recent pickup in US and Chinese PMIs. And, they've just got to have something on. So I think a very large number of investors have a small to moderate copper position now that they didn't have 6 to 8 weeks ago. And that's why we're $1,500 higher.
It's interesting because you mentioned the rate cuts. I assume, are you looking at this from a more global perspective? Because the probabilities in the U.S. look pretty dim right now.
I mean, the move in gold and copper and a number of other base metals has been despite the kind of pricing out of Fed cuts this year, right? And that's been even more impressive, I think. Yeah, look, I'm broadly referring it to being nearing on the horizon in the sense that, the last 18 months since the European power crisis kind of initially came back May 22, and then, you had the Fed hiking cycle through that. People have just been holding off and holding off and holding off. And, come March this year, a couple of months, very low activity in the commodity space. They're looking around for the trades of this year, and the trades of this year, the chosen trades of this year have become gold and copper. And, in part, that's because we're getting closer to the cutting cycle, even if it's been pushed out by a couple of months.
Why undaunted by a slowdown in something like electric vehicles and maybe broader fears that electrification as a thesis isn't, holding up to all the hype, at least this year?
Yeah, I think there's almost two EV markets. There's the EV market in China, which is still booming and shifting somewhat towards what I think will be the future of electric vehicles, which are these extended range electric vehicles, which basically have a gasoline generator that just charges the battery whenever you run down the battery. So you essentially don't need to ever, as long as you're charging the battery, you hardly ever use any gasoline. These things extend the range from 150 kilometers up to 800 kilometers in big trucks and 300 kilometers up to 1,500 kilometers in SUVs. So I think that market, the hybrid market in China, has really taken off the last 3 to 6 months, and that's going to be what's happened over the next 2-3 years outside of China eventually. Outside of China, look, there's talk of tariffs, there's talk of weakening sales, downgrades on electric vehicles. These vehicles, they're more exposed to lithium. They use a lot more lithium hydroxide. The Chinese vehicles use lithium carbonate predominantly. And so one of our top bearish, top trade ideas that we just published yesterday with 40% upside over the next 3 months is to go short August 24 lithium hydroxide as a reflection of this EV air pocket trade outside of China.
Interesting. Another bullish thesis for copper has been AI, right? And how much power is going to be needed to run AI. Are you baking that into models? Do you have an idea of what those numbers could look like? Or is that maybe, something that's in the offing, but it's hard to think about right now?
Yeah, I mean, it's certainly hard to nail down a number, in part because some of these AI plants with the new chips, with the kind of best tech, well, some of the latest tech from NVIDIA, they're not getting, they're only getting built over the next 6 to 18 months, right? So people don't know the exact intensities yet. It's hard to nail that down. But we've got an assumption of around 20,000 tons of copper per gigawatt of power consumption from these AI plants. And with that assumption, together with a broader kind of crypto and data center copper consumption forecast, it's added around about 100 to 150,000 tons to our copper deficits for 2025 and 2026 in each of those years. So we're running pre the whole AI story around 200, 250,000 ton deficits per annum, 2025, 26, and now it's looking more like 300 to 400,000 ton deficits per annum. So it's not nothing, and it's certainly got people excited. I think part of the reason it's so exciting is because it's the first US-based copper demand story that I can remember in my entire career.
Fascinating. And before I let you go, I just want to get your quick 2 cents on gold, the rally. More room to run?
Yeah, we think so. We think this is the year. The next 6 to 12 months is going to be a fantastic gold bull market, and we think we're on a path to 3,000.
3,000. And what is that predicated on?
Yeah, of course. I mean, in part, it is a reflection of gold's got a bit. It's got a bit of something for everyone, really, actually. But it seems like it's a bit gold. The outlook for gold is a little bit of Goldilocks. If the Fed keeps rate high, then there'll be a subsection of investors that'll be very concerned about debt service and government debt. And if the Fed cuts real rates come down, and gold historically has done extremely well. Like I think of second half 2007, where gold and silver had really strong bull markets when the Fed cut from 5 to 2%. So it does feel like gold's got it going for it, whichever way you want to cut it.
All right, Max.